So I'd like to begin by taking questions with respect to the problem set that you're working on, and then also talk about questions you might have with respect to the Excel assignment that you got this week. So what can I help you with?
7 and 9.
Okay? Okay. We're going to talk about 9, 10, and 11 in a few minutes separately. But let's look at 7 real quick. And I think the answer to 7 sets up some of the answers for 9, 10, or 11, by the way. What is the discount rate or the investor required return that we've used for the investor's perspective on this? What's been given to you?
20%.
20%. What is the discount rate from the perspective of the firm as you've calculated?
9.4.
9.4.
Right. And if you actually extend that out, it's like 9.3985 something, something, something. So when you actually run your valuation, if you run it at 9.4, you will get a somewhat different answer than when I ran it, because I ran it using the whole number. The answer is like $1,200 difference, or it's 0.008% difference. When you're dealing with, I think it's $16 million, is $1,200 something to even discuss? Pretty much not. So if you get that close on a number, you're not wrong. You just you input a slightly different rounding mechanism. Okay? All right. Okay, so 9.4% versus 20%. Is it reasonable for an investor who is only investing capital, money, passive investment, is it reasonable for that investor to receive a return on the investment meaningfully greater than the company's opportunity cost of capital?
No.
Why not, Zach?
Well, if based on their internal operations, that's what they estimate, then I don't know if you'd want to think that you could do better.
You know, it kind of is based on their internal, but it's kind of not. Think about the components to WACC for a minute. So we have RE. What is RE? Don't give me the equation for it. Just give me a just.
Value of their
Well,
stock.
yeah, no. It's the cost of their common stock, right? But what cost? Bobby, what opportunity? Well, I just said the word. So
Opportunity cost.
thank you, Bobby. I love it when you come back with the correct answer so fast. So if that really is the accurate opportunity cost in the market today for an investment in that kind of common stock, is it reasonable to think that an investor can get an amount different than that amount, that percentage? Or should those numbers be the same number? I mean, theoretically, that is the same number. We can say the same thing for RP, right? And RD, well, RD is current yield on that type of debt. So again, it's the opportunity cost. So if you think about a market-driven WACC is the opportunity cost, not just of the capital from the firm standpoint, but for any prudent investor that is investing in those kinds of assets. I mean, if it really is opportunity cost, right? So an investor that wants to invest in the whole firm, which means they are getting those kinds of assets, right? If they're expecting their return to be greater than the market's opportunity cost of capital on those types of investments, how accurate are they, or how realistic is their expectation? It's not. It's not. So under what conditions might an investor be able to expect a return greater than the company's opportunity cost of capital? Exactly.
They had some kind of influence.
If something else is being brought to the table, time, talent, relationships. If the firm is going to be absorbed into another large firm, I'm buying it and I'm absorbing it into another firm in my company, right, or in my portfolio, and now they're going to be able to get the cost of capital that that firm has. Maybe it's a lower interest rate on debt. Maybe they're going to be able to benefit from some best owner premiums. What's a best owner premium? Does that mean anything to you? Bobby?
Isn't it like the advantage you get when you have like an owner that can do something that the previous owner couldn't, or that
Yeah,
other owners
that's exactly
couldn't?
what it is. So here I am. I'm just some schmuck living in south of Payson, Utah. I've got my little company. It's not a very good labor market. I mean, labor's cheap, but it's not terribly highly skilled, maybe. Transportation down there from a rail hub is really expensive, right? Energy costs in Payson are ridiculously expensive compared to other parts of Utah. What if a better owner had the wherewithal to move the operation near a rail hub and near an energy hub in Salt Lake? Would they have lower input costs? Yeah. Maybe they wouldn't have any better labor costs, or labor costs might go up, but the productivity, because of the average education per capita, would go up perhaps yet more so. So maybe just by virtue of being willing or thinking about or having the wherewithal to make that move might give me a premium that the current firm doesn't enjoy, right? That would be a best owner premium. Or you absorb it into my company, and the products of the company that we're buying are complementary to the products that my company currently produces and sells. And so now we have a whole new group of customers. If my company's bigger, it's a larger group of customers that might be interested in these complementary products. And maybe it's a marketplace that it hasn't had exposure to, and so all of a sudden we have a sales benefit, right? A best owner premium, or some kind of an adjustment in this case, a best owner premium on sales would be an increase in sales, right? A best owner premium on expenses would be a reduction of expenses, right? Okay. So, unless a new owner, unless the new investor knows something the old investors and owners don't, brings some influence that the other ones don't, brings something in time and talent that their capital, their money, doesn't immediately bring with it, there's no reasonable expectation of a different rate of return, or meaningfully different rate of return, right? So now that we've got a 20% investor R and a 9.4% WAC, now how realistic is the investor's R? It's not unless they're bringing something else to the table. Okay? And some version of all of that is number 7. There's about 1,000 correct answers. So I put that there to get you to think through that dichotomy. I'm going to wait on 9, 10, 11. Okay. Yeah?
For 7, would it be fair to say that they have a relatively high WAC because it's like a relatively new firm? Therefore,
Is that a high WAC? Is 9.4% a high WAC?
I feel like they are.
Why? Are you thinking of WAC like an interest rate on debt?
Yeah, kind of.
How come? We want to do that, right? Cost of capital. We want to think of it as an interest rate on debt. I don't know why we do that, but we do. And compared to today's interest rate on debt for consumers in the market, it's really high, right? It's like double of what you'd pay on a mortgage on a house. So it sounds really high. But now think about it in comparison to what returns on the investment markets are giving. So if you've had money invested in the S&P 100 for the last 2 years, is 9.4% a big number or underperforming? Underperforming. So now is 9.4% a big number? Yeah, we tend, I don't know what it is, we tend not to intuitively connect WAC to markets that we see in front of us. And it's not just you and it's not just me, I've seen it hundreds of times. I don't know why we do that. So it's all about what you compare it to, and remember that it's an opportunity cost of capital now. It's market, it's now, as now as we can get. So you've got to think about a comparison to the markets, and all of a sudden it's not big.
So could it be right, depending on how I worded it, if I said like it's a relatively high WAC compared to the market now, therefore we need like to attract customers?
Well, no, that wouldn't be accurate, because the market now, I mean, return on invested capital in the markets today, weighted average cost of capital for firms today, that have much in the way of common stock. If their stock has been performing as the market's been performing, probably is yet higher still.
Okay.
Now, again, go back to why I put that question there. It was to get you to think about it, right? So I'm not worried too much about right and not right. If it was a test, different ballgame, right? But on this, I'm not too worried about it. I want you to think about it. What else? Okay, so let's then talk about 9, 10, and 11. And Kira reminded me, maybe it was Sherry, this morning that in my little note to you, I think I told you questions 1 through 9, and then we would talk about 10 and 11. And what I meant to say was questions 1 through 8, and we would talk about 9, 10, 11. But whatever. I think you actually were I think you were prepared to think about 9 if you wanted to. So how might you reconcile the value assigned preparatory to making an offer to invest in the firm versus the value you might now calculate? What am I even asking about? So was there a $20 million price? Yeah, there was a $20 million price. That was something that was assigned, right? Okay. But now you've calculated this, and if it was assigned by the firm, right? But now, using the firm's cost of capital at 9.4%, now what value would you assign for the firm? Have you done number 8? What value did you assign for the firm using the opportunity cost of capital from the firm?
$147 million.
That's the one I assigned. So now, your $20 million price tag, is it high or low? It's silly. In fact, if you're selling this firm for 20 mil, there's a problem, right? What if you used a 20% discount rate instead of 9.4%? Do you have your spreadsheets up in front of you that you use to calculate all this? If you do, you should be able to just change, instead of the 9.4% WACC you calculated, just type in 0.2 and see what happens to your valuation. This is why I love models, by the way. So when you type in 0.2, what happens to the valuation? Does it change from 147 million? What's it go down to, Kara?
22 for the 22 million.
22 million. So the 20 is even lower still, right? Okay. So partially, this is answered by you just being able to do that. Partially, you can answer this with respect to just thinking about net present value. What's the net present value on this if the present value is 147.8? 127 million. What might the internal rate of return be on a net present value of 127 million based on an investment of 20 million? Is that going to be big internal rate of return? Gargantuan, right? In fact, I think I calculated it here. Do I give it to you? Yeah, 20.14. And I have an extra decimal point in there, 20.14.72. I don't know what that number is. Okay. Yeah, so if you look at this, this is a big rate of return for a company that's got a 9.4% WACC.
I think you're saying using the R of 20, you have a 14.72.
Is that what I'm saying? Yeah, which would make sense in an IRR of 20.1472. Those would be consistent with each other. Yep. So again, this one was just designed to help to get you to think about this, you know. Okay. Number 10. I think now I simply ask you to create a valuation using a key value driver model. Did any of you attempt this? It's okay if you didn't. Okay. So in this case, we know that our value at time 0, the sum of the free cash flows at times I divided by WACC, oops, excuse me, 1 plus WACC to the T plus the free cash flow at time 1 divided by WACC minus G divided by 1 plus WACC to the T, and that equaled 147,869 something, right? Because you use the free cash flow model to do this. If we used the KVD model, how does this equation differ? We've talked about the key value driver model, right? How's the equation differ?
Using no plat to get our cash flow, we're using no plat to calculate.
We're not in the explicit period. In fact, in the explicit period,
Free cash flow time 1.
is that any different than the free cash flow model? Same thing. So the present value of the discounted cash flow is going to be the same. Now, no plat comes into play, right, Zach? Because now we're using a different definition for free cash flow. This one used the fairly garden variety free cash flow equals no plat plus depreciation minus change in net working capital minus net capital spending, right? But the key value driver model uses the definition of free cash flow we've talked about many times now, and it's no plat times 1 minus G divided by ROIC. And then WACC minus G is our divisor, divided by 1 plus WACC to the T. So the only difference is found in this part of the equation. So if you remember this, then it's pretty easy to take your model and now morph it to give us this as a continuing value, which is why I believe I said that no plat at time 1 was equal to, no plat at 0, excuse me, 26.5, is that what I said?
Yeah.
Okay. Is it 26,500,000?
Yeah.
Okay. So if that's the case, what value are we going to use for no plat? Or how do I find the value that I'm going to use for no plat? If this is no plat at time 0, the time 0 is continuation time 0 in this case, I believe I said, right? Confirm that? Well, I said it's at year 13, which is year 13 time 1 or 0? Excuse me, I think it's time 0, isn't it? Yep. Year 13 is time 0, which is the last year of the explicit period. So what do we do to a value in the last year of the explicit period to move it into the first year of the continuation period, or time 1 of continuation, right?
Just kind of go to the present.
No, we're not going to do it yet because we're taking it into the next year. We're not coming present yet. Alex, is that hand?
Yeah, don't you multiply by the growth rate and the
Yeah,
continuing
we're going to multiply it times 1 plus that growth rate. So what was the growth rate?
0.04, I believe.
4%?
Yeah.
Okay. So 26.5, 26,500,000 times 1.04. So it's going to then give us a value of, is that 27,560? Times 1 minus 0.04 divided by, what was our ROIC?
0.13.
0.13? That's what I thought, 13%. Divided by 0.094, which is WACC, minus 0.04, divided by 1.094 to what power? 5, 6, 7, 8,
The final year, 13.
13. So if you can calculate this, and you can, of course, and I believe that came out to 109,939. I think. So if you can calculate this, so it's a continuation value using the key value driver structure, add it to the value you already got for this, you're going to get a new value. And that new value should be 145,613 and some change. And I think the value we got originally was what, 147 and something, right? 147 what?
869.
869. Oh, I've got it written right up there, don't I? For what?
498.
Thank you. So are these two values very different?
No.
Really not. I mean, let's be honest. They're $2 million difference, and to me, $2 million is a lot of money. So I'm impressed when you say that's not very different. Okay, you guys apparently are more well-heeled than I even imagined.
You're the one that anytime a problem goes up, you're like, that's not very much money. And I'm sitting here like, that's a ton of money.
But on a relative basis, it's barely 1%. It's barely 1%. It's a little over 1%, right? The difference. But you're right, $2 million is a lot of money, unless you're dealing with $150 million. All of a sudden, it's not that big a deal, right? A billion here, a billion there, you can see what we talked about. By the way, who is that quote attributed to? A billion here, a billion there, and pretty soon we're talking about real money.
Rick Haskell.
No. A billion anywhere, we're talking about real money. It's Rick Haskell. My gosh. Okay. Teddy Kennedy. Teddy Kennedy. John Kennedy's youngest brother when he was a senator. Okay, so that's not a huge difference in relative terms. Is that fair, Garrett? We're okay now? What does it tell us about the G that we're using?
That it fits. I don't know the right word for it.
That it's relatively
That's
well
relative,
aligned
yeah.
with the G that we could have observed in the change in net working capital and net capital spending, right? Because it's that in this equation, that's the only thing we're guessing on, right? So the G that we could have observed through the free cash flow equation itself and this 4% G that we're imputing are relatively similar G's. If they had been exactly the same G, we'd have gotten exactly the same number. But they're pretty darn close to each other. In fact, I think, I thought maybe I had actually calculated it for you. In another problem set, I show you something like this again, and then we reverse engineer the G and find that G that way, which is kind of cool to do it like that. Okay? But they're pretty close. Number 11. How is it that including the firm's return on invested capital of 13% made such a significant difference in calculated value? So the key value driver brings in that variable that's not brought in any of the other form, right? Is it that variable, Cole? Is it the 13% that causes the key value driver number to be so different sometimes?
No, it would be the growth, wouldn't it?
Well, growth is part of what it is. But the ROIC is part, and so is the WACC. Here's something to remember. When ROIC is greater than WACC, growth creates value, right? We have an economic profit, because ROIC minus WACC is a positive number. So if we now apply that to expanded invested capital, we expand the stakeholders' value. I think you're pretty aligned with that. And we already know that when, I should have put it all the way out there. We already know that when WACC is greater than G, that we don't end up with a problem in our denominator of our continuation term, right? When WACC is less than G, we got trouble. Okay? So really, to get a consistently positive valuation, really, we need to have a condition that looks like that, don't we? Return on invested capital being greater than weighted average cost of capital, being greater than the growth rate. Have we talked about this in terms of why is that, on one hand, an intuitively meaningful relationship, and on another, why is it problematic? Have we discussed this yet? Okay, I didn't think so. So think about this for a minute. You can immediately understand why having a return on capital greater than a cost of capital is good, right?
Yeah.
Returns greater than costs, happiness. But is it immediately intuitive as to why having a growth rate that is less than the cost of capital, why that's good? I mean, Cole, Stratton Enterprises,
What's that?
is it R? Is there an R in there?
Yes.
Okay, thanks. Stratton Enterprises has a 19% growth rate and only a 7% cost of capital, and you're the CEO. Are you immediately upset?
17% growth rate? No.
No. In fact, not only are you not immediately upset, I think you're freaking ecstatic. Okay, because that's a pretty good growth rate, and I would say almost any business. Certainly one as venerable as Stratton Enterprises. Okay? But it gives us terrible heartburn in your continuation term. Why?
So you just can't get a value, is that what you're trying to say?
Well, I get a negative value,
Yeah.
and no bueno, right? Right?
I was just gonna say, you get a negative value if you show that you're growing faster than the capacity of your firm.
Tell me more about that.
So by having a growth rate greater than your cost of capital means that you're growing more than the capacity, so eventually you'll get to a point where you can't afford to grow as fast as you are.
And it's interesting, having a growth rate greater than your cost of capital doesn't all by itself mean that you're growing faster. But when you use it in these equations, it infers that. Because you got to think about what's going on in the denominator as well, right? Remember that this continuation form right here, use red to help us identify it. This continuation form is the sum of the free cash flows divided by 1 plus WACC to the t, growing at a constant rate for perpetuity, right? How does a company get the capital to grow? What are the ways it gets capital to grow?
Issue common stock.
So it can go raise new capital. How else?
Debt?
Well, that would be raising new capital.
Okay.
What is return on invested capital indicative of? Retained earnings. So companies get the capital to grow based on their retained earnings, and if that's not enough, based on going out and getting the money in the outside market. That's where it gets the money from, right? Those are the only two options that I can think of. So when we have a free cash flow, do we expressly have the term return on invested capital in our free cash flow definition? No plat, plus depreciation, minus change in net working capital, minus net capital spending. I don't see ROIC in any of those variables. But do I really remember this? Think about this. Free cash flow, no plat, I'm just going to say it's NP for no plat, plus depreciation, minus change in net working capital, minus net capital spending. We don't see ROIC as a variable there at all, do we? Do we see one of the two inputs to ROIC? No plat. Remember? It's right there, right? Don't see the denominator, do we? Or do we? Isn't invested capital the same thing as change in net working capital and net capital spending? Because this is change, essentially a change in fixed assets. And this is change in the difference between current assets and current liabilities. So it's not expressly and exclusively invested capital, but it certainly gives us an idea as to what's going on in invested capital. We don't see ROIC expressly in this equation, but we see it in this one. It's why this equation that is sliding down right now and this one are the same equation. It's what connects them. In fact, if you took this equation for free cash flow and disaggregated it and put it back together, you get this equation for free cash flow with an assumed G. So if you do some algebraic sleight of hand accurately, you got the same equation. So this other one, they didn't just think of this out of a Cracker Jacks box. This is an algebraic derivation. Okay? Yeah.
If evaluators ever have a slightly lower whack than G, will they just kind of like bump it up? Kind of like, I don't know, just so they can get a number, or will they resort to a different equation?
So a slightly greater WACC than G, which means the denominator is tiny, 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 which means the value of the term.
No, I'm
is
saying like
huge.
if they have a lower whack than G, so you get
Oh,
a
got it.
number.
Got it. Well, I think that that's a really good question. I'm not sure that I necessarily know the answer, so I'm just surmising one. Okay. I think that if we start to assign values to assets by discretionarily changing the variables, then the value of our valuation is not very good. I think. It's kind of like if you're doing medical testing, you don't like the outcome, so you change one of the inputs just to get the outcome you want. That might not result in overall good health. Maybe not, right? So my guess is that wouldn't be a good idea. Now, that said, we might look at this and this relationship, and then we might think about the investor's discount rate. So if G is slightly greater than WACC, is G probably greater or less than an investor's required return? It's probably a little bit less, depends on what the word slightly means, right? But if this is 10% and this is 10.01%, I think that a prudent investor would maybe have a return expectation of 11%, not much different than WACC. I didn't say a prudent investor can't have a different expectation than the weighted average cost of capital. I just said it can't be meaningfully different. It can't be 20 and 9 and still be credible, right? It could be 10 and 11, 10 and a half, 10 and a quarter, right? And we've talked a little bit about the differences between bid and ask in this as well, right? Please, Zach.
So is the only, not only purposes, one of the purposes of the KVD model, so you could just use an estimated G, like is that the significance of that model? Because
It is a significance of that model. You're going to see as we get closer to the end of the term and we start to deal with valuation multiples, that the algebraic construction of a valuation multiple is through the KVD model for free cash flow. So I'm going to hold the rest of the discussion until then, so it'll make better sense to you then. Okay? So let's move off this. I want to talk about estimating performance now. Because this is all well and good. So far, if you've run any numbers, the numbers I've given you based on forecasts that I just put in front of you, I give you the cash flows and such, right? How do we get those cash flows really? Where do we find them? Go to a book and get them? We estimate them. How are we going to estimate them? What's the first thing? If we're thinking about our future for our company, or a company that we're analyzing to consider buying, all or in part, what's the first thing we're going to think about forecasting? Sales, revenue. So remember that when I talk about revenue, gross revenue, and I talk about sales, I'm talking about the same thing, okay? I think we've talked through that. So we're going to do a revenue forecast. different things that you're gonna think about to help you decide what next year's sales might look like, different from the year after, different from the year after, and so on, in some explicit period that you think you can explicitly, expressly, accurately forecast. What are some of the things you'll consider?
Internal growth.
So when you say internal growth, be a little bit more specific for me. I think you're right, by the way.
Expansion.
Okay, so we're gonna, market expansion. Internal growth could include our R&D, so product expansion as well. And when I say market here, I mean our expansion into the market rather than the whole market expanding. What else might we consider?
What if the whole market expanded?
Well, what about the whole market expanding, right? Yeah. Or in each of these cases, we're talking about expansion. Do we always necessarily only talk expansion? Do we ever have to think about contraction? I think you gotta think about contraction. I mean, my guess is that sometime in the next 15 years, we're gonna think about the contraction of the market for internal combustion engines as electric or some other vehicle power source begins to dominate. We don't see that contracting today, but my guess is at some point it'll probably contract, right? And if we're an internal combustion engine manufacturer, we're gonna have to think about it. So anytime we say expansion or growth, we have to think about the auditorium bit. What else? Do we think that macroeconomic issues might be important? Interest rates, GDP changes, expected inflation. Are those important? Probably. In fact, they probably help inform a little bit of this, but more, right? Anything else?
M&A.
Pardon?
M&A.
Yeah, we can think about that. That might be part of this, so I'm going to put it here. But it could be a standalone item. Mergers and acquisitions, we might think about being bought or buying, right? Or avoiding being bought, right? Sometimes we want to try to avoid being bought.
I know this is lower down on the statement, but like cost of materials, cost of goods sold.
Well, I don't think it is lower down. I mean, you're now talking about the expense side. We're going to get there. But if I think that expenses for my inputs are going to go up, am I likely going to be able to do an awful lot of this? So I don't think they're exclusive, Zach. I think you have to keep them in mind. Labor costs could be a big deal there, right? Do I have to think about any political issues? Yeah, so think about this nasty little term that none of you had to worry about until about 9 months ago. Tariffs. Does that make a difference?
Would that fall under macro or no?
Yeah, it's going to have a macroeconomic consideration, but you also have to think about it in a micro because there could be tariffs applied in other industries that are going to affect you. But if a tariff is applied in your industry, it really affects you, right? So you got to think about it from both standpoints. I think you can just kind of put this into politics.
Okay.
I think that as part of these two market expansions, we might also have to think about globalization, which obviously tariffs, politics are part of that whole deal, right? But 50 years ago, did we think a lot about expanding into other marketplaces on the globe like we do today? No, I mean, it's the natural thing today. If I'm doing well selling my products in the United States, I naturally want to now sell them outside of our borders. Maybe it's easiest to go Canada, Mexico, because they're right next to it, right? But how much harder is it to go the U.S. to New Zealand, the U.S. to France, the U.S. to Botswana? Shipping container. right? But politics and globalization go hand in hand. We have so much of this today because of free trade agreements largely, right? NAFTA, the European Union. Is the American Union, are you familiar with the American Union? No? It goes by a different name, the United States. Isn't that simply an American Union? Free trade agreement, we use the same currency, capital mobility, human mobility. Didn't that sound like the European Monetary Union? Same thing. Same thing. Cole, did you have macro from me?
No, I had it from, Falling Shore.
Okay. I have a whole discussion about that in my macroecon course that I haven't taught for a while. So we have to think about all of these things, right? And put numbers to all of them. You might even have to think about where we are in the leadership in our industry. Are we a leader in the industry? Are we? Is this an oligopoly? And we're the big company and there's 3 smaller ones? Do we have substantial pricing power? Okay. So we have to think about all of these things as we think about changes in our revenue. Well, a couple of these things are redundant. So if I look at the macro economy and I see an expected 7%, no, let me be more realistic, an expected 3% change in GDP, and I look at the market expansion of the industry that we're in, and I see an expected 4%. Am I going to add those 2 numbers together when I think about the growth of sales for our business? Or am I going to think the one is already embedded in the other? I think it's already embedded. I think this 3% is part of what makes this 4%, right? So don't add them up. You got to understand. Similarly, if I look at our company, and I've already said we've got a market expansion of 6%, we've got a leadership premium of 2%. Well, isn't that 4% for my industry and 2% for my firm already equal the 6% that I'm thinking about?
Yeah.
Okay. So you got to be able to think about what this means. If somebody else then brings into this and says, well, wait a minute, but we also have these new products coming to market that you guys aren't thinking about, and that's going to give us an extra 10% proportionally. Let's say we've already settled on this 6% number. Is that going to move that to 16% or 6.6%?
It's proportionally.
If it's proportionate, you got to think about they're not additive, they're products. Okay? But the first thing we do is we have to come up with a revenue value. What do we think revenue is going to look like next year? And you could look at all of these over, say, the next 5 years on average, or you could look at next year expressly, and then look at the year after, and then look at the year after, and look at the year after, and come up with different numbers for each year. I think that the majority of firms, and certainly the majority of analysts that are doing this kind of work, are looking at each particular year. Because you might have some averages, but depending upon when you are above and below those average in time, makes a big difference in your outcome when you take a discounted value of it. Okay? So I think you look at each and every year individually. Let's assume now that we know what next year's revenue is going to look like. How do we now think about next year's expenses? Let's assume that next year's revenue, we took it at an expansion of 6.6%. Now, how do we figure the change in expenses?
Well, I feel like you could look at expected units sold and do that kind of thing to get your cost of goods sold and hours worked, or could you just, I mean, I know you can't just take all the numbers from previous year and
Well, it depends. We have to answer another question before we can think about expenses. Do we believe that as our company grows by 6.6%, do we have a constant returns to scale or increasing returns to scale? When I say increasing returns to scale, what do I mean?
the bigger you get, the higher percentage of returns you have?
Yes, because in this case, the bigger you get, the less you pay for any particular input. So economy of scale. Is that what you're about to say, Garrett? Okay. So if we think a 6.6% growth in our firm is going to let us negotiate lower input costs, then we probably have increasing returns to scale. If we think that it doesn't change our scale economy, then we have constant returns to scale. Here's something I can tell you. That the 100 firms in the S&P 100 and the 30 firms in the Dow Industrials, those are the biggest firms in the country, right? Are they probably already at optimum scale? That getting bigger is not going to help them drive input costs down much at all? Yeah. We see that they are pretty much at constant returns to scale. But we take Rick's Dry Cleaners. I've got 2 locations. I want to move it to 100 locations over the years. Should I be able to get better input costs as I get to 20, 30, and 40? Yeah. So you got to think about where your firm is, right? We're going to model first constant returns to scale. And then we will adjust that later to think about modeling changing returns to scale, okay? So let's think about this. I'm just going to be super, super simple for a minute, and then I'll expand it a little bit. Make it a little more complicated. I want to talk about forecast ratios. And I'm going to say that the first forecast ratio we look at is a forecast ratio in sales. And in this case, we already said it was 6.6% from our assessment on the other. I want to look at forecast ratios for operating expenses, forecast ratio for interest, and we're going to think about them in a completely different way than we thought about forecast ratio for sales. Okay? Is that a hand, Bert?
No.
Okay. So if we had in 2000, the year 2000, and we're going to say that's our base year, that's year 0, that's real year 0, not continuation 0. Let's say that we had revenue of $1,000. We had operating expenses other than depreciation, so not including depreciation, of $600. We had depreciation of $50. So we have an EBIT that is what, $350? Is that right?
Yep.
And if we think that we are at constant returns, or we just want to first think about constant returns, which you would even if you're not there, you will first want to think about constant returns, then do I have a ratio of operating expenses to revenues that I can think about? And if I think I'm at constant returns, will that ratio stay constant?
Yeah.
Yeah, if I think I'm at constant returns. So a forecast ratio for operating expenses is going to be the revenue, the expense in year 0 divided by the revenue in year 0, which in this case is going to equal 60%. If in these operating expenses I didn't include depreciation, if I do include it, it's going to equal 65%. So what I've just done there is I've suggested that depreciation moves at the same percentage as revenues. Depreciation, expenses, and revenues are all changing at the same percentage. I don't know if you immediately see that, but that is what I've just suggested. Is that a reasonable thing to suggest?
You have constant.
Yeah, you're constant and
But isn't depreciation a non-cash expense based upon my acquisition of capital goods, not inputs to production?
Well, if you use a straight line depreciation, so every year's depreciation will be the same, right?
Well, if I use straight line depreciation, But how many different depreciation schemes are available to me that fit GAAP?
Only the year that you're available for the fixed assets year, like their life, right?
Well, you're trying to think about taxes and the depreciation scheme that the IRS would apply for that year for the assets that I acquired, right? But I want to talk about GAAP. Remember that the GAAP is where the tax rules come from, but GAAP does not constrain the tax rules. So I can think about straight line, double declining balance, ACRS, MACRS, or I can think about what the IRS and GAAP calls reasonable. So that's immediately 5 different depreciation schemes. Whereas I probably am going to be constrained to use one of them when it comes to accounting for taxes, which is different. GAAP is used to communicate business realities. Taxes are a reality in business and not the only reality in business. Okay? But more importantly, when I've included depreciation in here and said that depreciation is going to have the same kind of relationship, I'm suggesting that as my sales rise, my capital assets must be rising in value as well. Or to get more sales, I need to invest in more capital assets. If I'm printing posters and I want to print 20% more posters, I probably have to buy another 20% more printing presses. It's probably a reasonable assumption. Or I wasn't using my printing presses to the fullest capacity, in which case I do have increasing returns to scale. But since I'm trying to think about constant returns to scale, if I'm going to have more money in revenue, I'm going to have more money invested in capital assets, buildings, equipment, trucks, computers, etc. So in that case, it is reasonable to believe that depreciation can be lumped into this as well. So the forecast ratio construction for depreciation as a particular input cost is no different than the construction for forecast ratio for any other input cost for operating expense. Now, I'm generalizing this and saying that I'm taking the whole operating expense divided by the whole revenue and getting a ratio. But on your income statement, you don't have just one operating expense, do you? You've got salaries, you've got labor, you've got raw material, you've got marketing. I mean, you go on and on and on. And for every one of the categories of expense on your income statement, you are going to come up with a unique forecast ratio for that expense. Okay? Does that make sense? These might sum up to, including depreciation, these might sum the whole $650, but I got to tell you, on your income statement, you didn't simply have operating expense $650. You got it broken down. And as we create models, which you've begun to do now, you're going to be doing a model for forecast ratios relatively soon. I think it's next week. You'll start to work on it, I think. And you're going to think about a forecast ratio for every one of those expense items. But in a constant returns to scale world, this ratio will give me next year's number, and next year's number will have grown at the same rate that the sales grew in a constant returns to scale world. Even with that, I want you to come up with different ones for each, because we're going to go from constant to changing returns as we make the next move. Okay? So let's look at some possibilities here for me. Come back over here, and we'll say we had these revenues and these expenses for a second. If that's the case, what is my revenue for 2001?
1,000 plus 1.066, right?
1,000 times 1 plus 0.066. Yep. So what's that? Is it 1,066? So if I've now calculated my 2001 revenue, what's my 2001 operating expense gonna be?
65%.
It's gonna be 65% of that, right? Because we've said that in total, it's 65% of the revenue. Well, I'm gonna encourage you to always at least break out operating expenses without depreciation and depreciation separately. Why would I do that at a minimum? Because we need to know depreciation separately to calculate free cash flow, don't we? And the whole reason we're doing this is to calculate free cash flow for future periods of time. So we got to keep free cash flow separated out. That's why I separated it therefore. Okay? So in this case, I'm going to say operating expenses 2001 without depreciation is 60% of this. So 1,066 times 0.6 or 621.
0.6.
And depreciation for 2001 is going to be what? 50? Well, it was 50. We're going to increase it by 6.6%.
53.3.
Yep, 53.3. Because we're going to increase it by the same 6.6%. What we actually did was you took 1,066 and divided it, or multiplied it by 1.05, didn't we? Or no, we just took it times 0.01.
So, real quick, were you saying to do operating expenses by 60% or 60%?
Yeah, because I took these operating expenses without depreciation, and that's what this was.
Right.
Okay, and so that gave me 1,066 times 0.6,
Okay.
which I believe was the 621, right? To get the depreciation, I take the 1,066 times
The rate would
0.05. 50 divided by 1,000 was my forecast ratio for depreciation, right? Every one of these kinds of expenses is done in this way. So this included 600 divided by 1,000, and it included 50 divided by 1,000 to get that 65%. It was 60 and 5. Cool. Do I now know EBIT for 2001?
Yeah.
Sure I do. 1066 minus 621 minus 53.3 is my EBIT. If I know EBIT, do I now know no plat? What else do I need to know no plat?
Tax rate?
Tax rate. Yeah. So how do I find my tax rate? Do you have access to a federal income tax calculator that covers the year 2000 and 2001? Take the EBIT, plug it in. It's going to give you the tax amount and the tax rate. You now have the tax rate. You now have no plat. We have to be thinking about this equation. Let me write it on the other board since that's the one that's being hit by the recorder. We have to think about free cash flow being equal to no plat plus depreciation minus net capital spending minus change in net working capital. So in order to forecast free cash flow, we have to come up with each one of these measures. And what we're doing right now is coming up with no plat by having come up with EBIT, by expressly forecasting revenue and expense. Fair enough? Cool. Now, how am I going to forecast net capital spending and net working capital? Are there incomes and expenses in those numbers? Not really, are there? Those are balance sheet, and the others are income statement. I have to make another set of assumptions. Is it reasonable to assume that as a company's sales grow, their invested capital grows as well? if a company's making money off of its assets, that would have to be true. And again, if you look at the S&P 100 and the Dow 30, there is a direct correlation that only varies a little bit year over year, but averages direct between their invested capital and their sales. So that correlation is constant. Now, that's because they're at constant returns to scale. If they're in changing returns to scale, that's going to change, but we'll model how to do that later. Okay? So what I've just suggested is that there's a relationship between revenue and invested capital that might be a constant relationship. So if we know the invested capital value for a company, which is embodied in these two, right? If we know the invested capital relationship or the value, we now know what that revenue to invested capital relationship is. So let's assume for a minute that invested capital for 2000 was 11,000, such that revenue to invested capital is equal to what? 11? No. What's 1,000 divided by 11? What's 1 divided by 11? .09. Okay. So we're gonna have to make that. We're gonna have to make an assumption, and I'm going to tell you that the appropriate assumption to make here to begin with is that we have a revenue to invested capital relationship that is constant. And if we are in constant returns to scale, that is a valid assumption. Okay. But I want to make one more assumption. And I want to make an assumption about debt. Pretty soon I'm going to introduce you to a model form that includes interest as, or some notion of interest in it, which the others have not so far. Okay? So I want to know about debt changes as well, because debt changes mean interest changes and interest expenses. So I want to also think about invested capital to debt as a ratio. And let me say that the debt for the company, and this would be long-term capital debt is what I'm talking about. Let's say that that was 3,000. So now I've got 11 divided by 3 is equal to what? 3.66. So I hate those numbers. 3 2/3. I know, I should have used a different number. Okay? Is that right? Yeah? Yeah? Okay. So now, can I think about forecasting my net working capital changes and my net capital spending? Well, as it turns out, I can. Because if net capital spending and net working capital have a relationship with invested capital, and invested capital and revenue have a constant relationship, I now can think about my net working capital and my fixed assets, can't I? So, if I know what this is, I want to find my net working capital for 2001. How am I going to do it? Well, I have to know my net working capital for 2000 to begin with, didn't I? So let's say that my net working capital was equal, I don't want it to be that big. Say it was equal to 500. Let's say my fixed assets were then equal to 10,500. Which they have to be, right? Why would my fixed assets have to be 10,500 if my net working capital was 500?
Because your invested capital is 11,000.
Because my invested capital is 11,000. Thank you, Alex. I just saw some blank books, and I wanted to make sure that behind them all was that. Okay? So if that's the case, now do I know what my net working capital is for 2001? Well, I first have to make another assumption. darn it. If my invested capital, which is the sum of my net working capital and fixed assets, has a constant relationship to revenue, can I assume that each of these also has a constant relationship to revenue? Yeah, I'm going to do that. Okay. It's going to make it easier for me. And if my revenue has grown by 6.6%, does this not mean that my net working capital also grew by 6.6%? It does. Okay? So I'm going to take then 500 times 1.066. And to find my fixed assets for 2001, I'm going to take 10,500 times 1.066 as well. So now do I have enough information to forecast free cash flow for 2001? I had EBIT that led me to no plat. I have depreciation. I have, do I have net capital spending? Do you see it? What's net capital spending? What's the equation?
Would it just be a change in investment?
Well, it's not expressly. What is it exactly? Fixed assets from 1 minus fixed assets from 0 plus depreciation. Fixed assets from 1 minus fixed assets from 0 plus depreciation. Well, this depreciation. So I have it, don't I?
Yeah.
Change in net working capital. Net working capital from 1 minus net working capital from 0 is change in net working capital. Please.
So to get to that point, you pretty much made an assumption off the 1.06 you kind of applied to everything, and so when we're doing like this type of work, do we just make those assumptions, or is it usually going to be given?
Well, it depends. I think that, and you're asking about for a problem set or exam.
Yeah, because to me, like,
right?
I see where you're coming from with that assumption, but it also seems like, okay, then you can interpret that many different ways with your certain assumption.
Yeah.
And so that's why I'm trying to grasp
So
that.
if constant returns to scale,
Okay.
then it's not an assumption, then it's a given, right?
Okay.
But we assume constant returns to scale.
Okay.
So it starts with assumption, right?
Okay.
So if we assume constant returns to scale,
Then you can use
then those ratios are a given.
Okay.
In which case, we can simply generalize and say that fixed assets and net working capital changed at the same rate that sales changed at. Because revenue, sales, is in our equation, is in our assumptive set, right? And in this case, in order to find debt, we made an assumption about invested capital and debt, but we first had to calculate invested capital to then think about invested capital and debt, right? And if we want to know what debt is for next period, the invested capital times, excuse me, want to know what debt is. I wish I'd done this differently now. Invested capital divided by whatever this number is, it's going to equal our debt, right? This being the number. So invested capital divided by our ratio that we believed was constant is going to equal our next year's debt. This now is just simple algebra stuff. By the way, I don't care if you assume revenue to invested capital is constant or if you assume invested capital to revenue is constant. Makes no difference, right? I don't care if you assume invested capital to debt is constant or debt to invested capital is constant. It makes no difference. So you're going to see that in different problem sets and in different templates that I've given you, I use them interchangeably. A couple of them is revenue to invested capital, and a couple of them is invested capital to revenue. It makes no difference. You're applying it simply to then calculate what the other number is. Kind of makes sense, right? We started with some assumptions. We assumed constant returns to scale in this case. Well, the assumptions we started with first were all the assumptions we used to get to our revenue, right? And then we assumed constant returns to scale, which meant that our various expenses had a consistent relationship against the revenue. And so we used a series of forecast ratios. And I've given you one, but operating expenses is a broad category. I might have a forecast ratio for labor, forecast ratio for management, forecast ratio for rent, forecast ratio for every one of the different inputs to my operating expenses, all of which are simply there to help me find all of those same operating expenses for the next year so that I can find operating income for the next year. And if I have operating income or EBIT, I can now calculate no plat. I already have depreciation because it's one of my operating expenses. I'm halfway to free cash flow now, right? But then I have to make another set of assumptions. And that is, if I said constant returns to scale, then I have a constant revenue to invested capital or invested capital to revenue relationship. That now is a given if I have constant returns to scale. Okay? And since net working capital and fixed assets are invested capital, if I will also assume that they grow at the same rate, they stay in proportion to each other, now I can calculate future net working capital and future fixed assets. And now I can calculate net capital spending and change in net working capital, and now I own free cash flow for every period sitting in front of me. That's explicitly forecasting. Well, if my sales rate of change from 2000 to 2001 is 6.6%, in 2001 to 2 is 6.6%, 2 to 3 is 6.6%, and so on, that makes it super easy. Should I likely generalize the sales change for each one of those future years as being the same change, or should I be a little bit more micro about it and look at the conditions for each year in front of me and see that they might be a little bit different? I think I should be a little more micro about it, right? Including, am I going to be relatively accurate with my sales expectation for next year? Relatively. Not exactly accurate. I'm going to say that yes, because it's only a year from now. If I know my company, I know my trajectory, I know what we're doing, R&D, everything else, I should be relatively accurate. What about the next year? Will I be as accurate? No. Well, yeah, darn it. Sure, he's technically right, because maybe I will be, maybe I won't, and probably I won't, right? And the next year, probably less accurate. So if I'm forecasting sales level for next year, and I don't know enough about the conditions in the next years beyond that, should I reasonably keep the same sales forecast for each of those years, or knowing that I'm probably increasing my inaccuracy each year, should I become slightly more conservative each year as I move forward in time? I think I should be slightly more conservative. Am I hedging my bet? Sure. Do I have a reason to believe that it's worth hedging? Sure, because I know that the further out I go, the less accurate I become, right? And then at the end of that explicit period, whatever it is, we now know I'm going to take a very nominal number, right? I'm going to take 3, 4, 5%, not 16, anything for my long-term G, so I don't have this explosive continuation value, right? That's completely unrealistic. That's why that number gets so nominal, because we move out so far into the future that we just know that we're wrong. And so I'd rather be wrong with a little number as my guess than wrong with a big number as my guess. Because if I'm wrong with a big number as my guess, then my probability is I performed less than that, right? If I'm wrong with a little number as my guess, probability is I outperformed it. When was the last time you were castigated in public for having done better? Never, right? Have you ever been castigated in public, humiliated in front of others for having done worse? Most of us have. If you've been involved in competitive sports, have you ever been called on the carpet by a coach? No.
Well, that's the day,
Yeah, in consistent blood leg. If you're going to be wrong to the good, not wrong to the bad, right? And that's what this is about. Does it make sense? Could you replicate? Shall we? Let's do a little bit. I am going to give you basics of something. And I just want to work on them together for a bit.
first day. First day out here. Should push the board. Excuse me.
So let's look at what we've got here. So, thank you. Everybody has it now? Okay. So on one side, we've got a simplified set of financials. You're used to seeing this probably, something like it. Income statement-ish stuff, balance sheet-ish stuff, a little bit of market experience. On the other side, I'm giving you year 0, which is the last year of our income statement, year 0. As 2016, I'm giving you those values. And I'm giving you some assumptions right above it. Assume constant debt to invested capital ratio. And I give you what the number is because I calculated it from the base year, right? And assume constant revenue to invested capital ratio. Again, I made an assumption and I calculated it from the base year. Here on the left, I've given you long-term growth. I've given you some tax numbers. I've given you a WACC, so a cost of capital. Here in the, just right in the center section, I've given you some numbers you probably aren't going to need to use. Okay? We'll talk about those later when we come to adjusted present value. But here in the far right, I've given you a sales forecast. So I'm saying we believe sales are going to grow by 8.6%. And let's, in this case, we're going to use that sales forecast and let it populate 5 years worth of explicit period. Okay? So working groups of 2 and 3, you decide your groups. And the first thing you want to do is come up with your expense forecast ratios. So we're going to take operating expenses without depreciation and find that forecast ratio. Depreciation, find that forecast ratio. Then I want you to think about applying those forecast ratios and the sales ratio, sales forecast of 8.6%, to come up with revenue, operating expense, and depreciation for each of the next 5 years. Then I want you to come up with no EBIT, no PLAT for each of the next 5 years. Should be easy, right? And then net working invested capital for each of the next 5 years. Which, if you've got a constant invested capital to revenue ratio, and you identified your revenue, you now know each of those years of invested capital, right? And then you can do the exact same thing for net working capital and for fixed assets, which then mean you should be able to calculate free cash flow. So start to do that together, which means actively work together. You're probably going to have to move. We're closing in on being done, so I'm going to bring up on the screen the next few years and show you how I got them.
Zach, for economic profit.
That's what I've been doing individually with
I
you.
did invested capital.
So I want you to focus up here, please.
Times R.
Okay. So look how I got Look how I got my revenue value. I took the revenue from this year times 1 plus my forecast ratio for revenue. So I went ahead and put a line down here below all this. Doesn't matter where you put this for today. I put there my different ratios. So I took then for the 2017 revenue, the prior year revenue times 1 plus my sales growth. Okay. And then to find my expense for operating expense, I took the new revenue that I just calculated times the ratio for my operating expenses, in this case without depreciation. And that gave me that number for 2017. I did the same thing for depreciation. That gave me that number for 2017. EBIT, I didn't do that. I calculate EBIT, because I know EBIT is revenue minus my operating expenses, right? So I calculated it. I could have done it differently and gotten the same number, but only in my constant returns to scale world. When we now take this same template that you're creating and expand it to changing returns, that would no longer have remained valid, so you have to calculate it the way you already know how to calculate EBIT. Okay? So invested capital, I went ahead and put my assumptive ratios right up here, just like a few of you are already doing, and I calculate them rather than input them. So my debt to invested capital is the debt for the base year divided by invested capital for the base year. My revenue to invested capital is the same thing. Revenue for the base year divided by invested capital for the base year. Those set my ratios, right? And when I said I was assuming constant returns to scale, that means I can now use those constantly. So to calculate my invested capital, well, actually for the base year I took it off the financial statement, but for the new one, I simply then take this relationship, revenue to invested capital, and think, how do I calculate invested capital? Well, invested capital, if I rearrange this, if revenue to invested capital equals a number, then to find invested capital, it equals revenue divided by that number, right? This is algebra. So I take revenue divided by that number to get my new invested capital. No plat, I calculate by EBIT times 1 minus the tax rate, which tax rate I've got embedded up here. I pulled that, by the way, right off of the financial statement information you've already created out in your first Excel assignment. To get net working capital, what did I say we could assume for net working capital and fixed assets in a constant returns world?
That it fluctuates with sales.
Yeah, so if invested capital is growing with sales, I said we can reasonably assume that fixed assets and net working capital are proportionally also growing with sales. So I simply take my prior year's net working capital, multiply it by 1 plus my sales rate, it gives me the new year's net working capital. I take then, for fixed assets, I do the exact same thing, bring them both off of my forecast ratio for sale. And by the way, when I did this to put the forecast ratio for sale down there, I simply copied it from up here. Okay? I just did that visually, just so it was easier for my limited little mind. Okay? But now, having done that, I now have all of the inputs for free cash flow. Right? Change in fixed assets, change in net working capital. Net capital spending was changed in fixed assets plus depreciation. I've got depreciation sitting right there. I now own free cash flow. And I've done it for each year, so I have forecast each year's free cash flow. Which now means I've owned my explicit period. Think about what I'm doing down here in the first year of my continuation. It's the exact same thing, except I'm not using 8.6% anymore. I'm now using my long-term G up there in the left-hand corner of 3%. But it's otherwise, along this row, it's the exact same thing. Nothing else has changed. So if I assume that my sales growth is constant through the entirety of my explicit period, and if I assume constant returns to scale, which means I have a constant revenue to invested capital, I have a constant debt to invested capital, It means my net working capital and my fixed assets are also growing at my same rate of sales. That's what it means when I'm assuming constant returns to scale. I now have forecast everything out during my explicit period and the next year, including return on invested capital, including economic profit. Nice and slick, right? Which means if I want to, and in a few weeks you will want to, I've already modeled out all my valuations for each of the years, or for each of the different models. If it's this simple, why am I putting you guys through all of this stuff, having to do it by hand and with your HP and figure all this and just doing it kind of a line at a time? Bobby?
So that you understand like where it comes from, not just how to plug it into Excel.
Exactly, because what happens when you now want to use a forward market multiple model? What happens when you want to have a different revenue change for each period? What happens when you go from constant returns to scale maybe to changing returns to scale? If you know how you built it and all of the underlying inputs, you now own this thing and you can do whatever you want. Okay? So what you've just done in starting this in spreadsheets like you are, is you've begun, I think it's Excel assignment 4, I think. I think you've begun that now. Which is not, we don't assign that until it's for next week, right? So we're going to hit some of this again on Wednesday. If you guys want to kind of get to the point where you catch up with me a little bit, or just get to where you've got one good line, 2017 forecasting. So on Wednesday, I'm going to talk about making adjustments to these things, which essentially could take us outside of constant returns to scale, okay? And then we'll finish this up together on Wednesday and start to look at the adjustments for going outside of constant returns. Okay? Fair enough? Any questions? Anybody need an Advil? Okay.
Invested
Can you
capital
highlight the 2017
Times.
free cash flow stuff?
and then in parentheses, ROIC minus.
Excuse me? Wrong one? So it takes no class plus depreciation
Yeah.
minus change in net working capital minus net capital spending, which is fixed asset 1 minus
I'm not
0
gonna do
plus
everything else.
depreciation.
Do you know other formulas you use it for the-
Yeah, you gotta remember that pesky little depreciation sitting over there.
Cool.
Yep.
Rick,
Please.